So what if I told you that you don't actually have to sit in front of the computer screen all day long just to trade Forex, but you can actually automate your trades and then save a lot of time for vacation and even time to hang out with friends and time to relax and do any other thing, enjoy life and whatever good and pleasant things that life has to offer. Well, this is okay, Manuel, and welcome to today's class. This is Beginners Forex Course 102, and I'm taking this time to welcome both new and old subscribers. And for the new subscribers, please, if you are new to this channel, just take 3 seconds of your time and hit the subscribe button. Don't forget to also smash the like button and also share this video to anyone who you know out there is looking for a way to actually automate his trade and make money almost on autopilot. So without wasting much time, let us dive into it. Welcome once again. It's the Beginners Forex Course 102. We'll be continuing from where we stopped in our previous class. So please, if you don't actually know what we're talking about, or you missed, as in you missed the first class, as in the previous class we had on Beginners Forex Course 101, I would advise you to check the video. The link is in the description below. You can check that video and then from there pick up and continue from where we stopped in the previous video. So in the last video we stopped at placing order, and then here now we will be talking about the types of order. So basically in Forex trading, we've already talked about that when you buy one currency, you need to sell another currency in exchange. If you anticipate that the price of the base currency will go high and then that of the quote currency will fall, so you buy the base currency and sell the quote as the counter currency, so to say. So then you can either choose a position to go long or short. When we say going long in the Forex market, we mean buy, to place a buy order. When we say going short, we mean to place a sell order. So that's basically that. And then now I will be talking about slippage. Very important. Now slippage occurs when a trade is filled at a price that is different from the requested price. So for some of you that have been trading already, you may notice that there are times you place an order and you just notice that your order was not actually filled at the exact place, that's the price that you requested that order should be filled. That's what happened there is that slippage has actually occurred. So, and there are about 3 types of slippage. There are about 3 types of slippages. Now, one is no slippage, then 2 positive, and then the third one is the negative slippage. Now, the positive slippage works in your favor depending on whatever direction you decided to take while trading. Then the negative slippage is actually not in your favor. And then we will go straight into it. So, like I said, no slippage, positive slippage, negative slippage, and then now I don't know how it's going to be, but okay, let me now jump into the MetaTrader 4 to show you how exactly slippages work. Now, what it means is that you may place an order at a particular time, at a particular point, and then you just notice that this order was not filled at the point, at the price level where I decided that, okay, this is where I want to enter the market. Now, for whichever way it happens, it, like I said earlier, it can be in your favor or against you. So let's look at it. So without wasting time, let's look at what we mean exactly by slippage. Well, let's hope I can find an example of slippage here. Okay, don't mind this. This was where I was trying to teach support and resistance and the various ways you can actually enter a trade regardless of a trending market. And then, so this is the Euro USD chart 1 hour. Now I hope I can find anyone around. Okay, now it's important also to know that slippages occur at moments of when in the market, when there is high volatility in the market. Now whenever there is high volatility in the market, or at the open of the market, or probably again when the market is not in its peak session, that's because every market has its a session, as it has its own session, has a peak moment of the session. So now when there are news events that are tending to cause volatility in the market, this can lead to slippages. You understand? So bear that in mind. Opening or closing of the market, volatility in the market as a result of whatever it is, could be news events or anything. So these are the things that actually causes slippages in the market. So now this is an example of slippage. I wish you can see what this particular point. Now notice that from this point, let me zoom in to the chart so you can see properly. Can you see this? Look very well. So notice that from this particular point to here, where the slippage occurred, this was not too huge, but this was around 10 pips. Now imagine a 10 pips movement against you. What is actually going to do? That is to say, if you are trading a standard lot, that is to say 10 times 10, you've basically, if this was a negative slippage, depending on the type of order, as in the direction of trade you are taking, automatically it means you are on $100 loss. You need to fix that $100 loss before you even begin to, at least before you break even. Okay, so now I talked about positive or negative slippage. So let me now take time to show you exactly what I mean and how it happens. Now, for instance, we decide to, looking at this particular price action, a pin bar price action that occurred here, and then somebody was already in somewhere around here, some pips below the pin bar, and then he got to here, that's 20 something pips. For whatever reason, he was still in the market. Now let's talk about someone who was coming in as a fresher into this market, and then he didn't really notice what was really happening. Now look what happened here. He came in and then he decided to place his order somewhere, let's say around here, just below this candlestick. The last candlestick before the gap. Now his order actually did not get filled at exactly this place, but had to come and get filled at the opening of this candle. Now notice from here to here, where he placed his order, he is already in 6 pips profit, because it is also moving in the direction of his trade. Are you understanding this? It is moving in the direction of his trade. So because he is actually selling in this market, and then the gap the gap actually occurred that's in the same direction of the trade he is taking. So that is what actually makes it a positive slippage. He is in profit already. The moment this thing starts reading, he is in the market with additional 6 pips profit. Do you understand? If you don't understand, you can go through the video again. Now, in the case of a negative slippage, now for someone who is going long in this particular, in this particular trade, now you understand, you decided that you want to go long in this particular trade, and you placed, okay, probably the market was here, you understand, or let's say, let's take for instance, let's say you started right from even somewhere, you placed your order that, okay, my order, I want to buy once this candle, at the close of this candle, somewhere around, because what it means is that you want to actually hit that, you want to enter at market execution now, and then you were, for whatever reason, probably because of the latency with your broker, and then whatever, if you're actually using a copy trader or something, and or not even a copy trader, let's say directly from your MetaTrader 4 or MetaTrader 5 account, and then you actually saw that, okay, this candlestick is closing here, and then the moment it closes, you say, okay, now I do not actually advise that you go aggressive in such manner. I have, in fact, if you stay with, in our subsequent videos, I'll be showing you perfect ways, perfect entries, better ways to enter the market and make real money without taking risks that will not actually amount to nothing. It's not really advisable that at the close of a candle you just hit sell or buy at the moment. No, it may be in your, you may do it for quite some time, it may favor you, but when it's gonna catch up with you, honestly, you are really going to pay for it. So now this is what happens here. At market execution price, you actually decide to hit the buy button here. Let's enable the buy button. You hit the buy button, boom, and the moment you hit the buy button, before your order has actually hit the server, now what happened was that you placed a buy order, bam, and the moment you placed a buy order, your order was placed here at 1.22532, and notice your order got executed somewhere around here. Let me use a horizontal line to mark it for us, because this was where this candle opened. This candle opened here, then we intended to enter somewhere around here. Is there any need to label it? Let's say this was where we hit our buy. This was where we hit our buy order. Now look at it, notice this. The moment you hit your buy order here, your order got executed somewhere around here, and you are like, oh, this broker, I hate this broker. This broker, in fact, they just know how to cheat someone, they know how to liquidate my account. No, come on, calm down. This thing happens to almost every trader in the market. So now notice what happened. Because it's a negative kind of slippage, your order got executed somewhere around here. So calculate this, you are in about 23 pips loss. So if your stop loss was here, you better pray that, okay, no, it doesn't get to here, and then try to at least compensate me to even break even, so I can just exit the trade. So that's just an example of a negative slippage. You entered an order, and then it didn't execute at the market price, which was where you placed the order, and was coming to execute itself somewhere around here, about 23 pips loss. So imagine, but whereas for someone who wanted to sell, was placing a sell order exactly, let's even say at the close of this candle. I don't know, for whatever reason he thought it was going to sell. Everybody has his intuition, and whatever reason they enter the market. So the moment you hit this sell order here, and it did not execute at there was a little delay, and before it got executed, your trade got executed somewhere around here. So imagine you were trying to enter here and it is getting executed here. So automatically you are in plus around 23 pips profit in this particular trade. So that is that for slippage. So we'll continue to let's continue from where we actually stopped. Types of order. We continue. So there are different types of order in the forex market. Some brokers offer a variety of orders on their web platforms, but we'll be considering the basic ones, the ones you see in your MetaTrader 4 and MetaTrader 5, and mostly the ones you come across from your day-to-day trading transactions or activities. So market order. Now market order is when, let's say, I want to just execute a trade at the current market price. Just it is the price of Euro USD is 1.3502. I hit buy or sell at that particular point. It executes at 1.3502 for me. Now limit entry order, we set this in as in it's a limit order because whenever it is assumed that, okay, don't worry, when I get to the chart I will show you how this thing works. So for limit order, you are speculating that the price will get to a particular place before it begins to go up or go down again. So at that particular place you can set a limit order. The same thing under limit order, there are two types: buy limit order and sell limit order. Now let me use this graph as in this object as an illustration before we get to the chart for you to show you practically how it is done. Now notice that this is where the price is. You understand? If the price was here, like for a buy limit order, now the price, let's say price was up. Normally if you want to set a buy limit order, it is being set below price. If it's a buy limit order, it's usually below the price, and if it's a sell limit order, it's usually above the price. So the price was actually here, and then this is our limit order. You can see it's been we actually tagged it a buy limit order. Now notice that price was coming all the way from here, and then it hit the limit order. Look at it, price was actually up. You understand? Price was actually up, then it fell to the limit order. The moment it hit the limit order, triggered it before it starts going up. So meaning that this price was actually heading up, but for whatever reason we know that there is a resistance above here that it cannot break at the moment, temporary resistance like that it cannot actually break. So we decided to, okay, say if it doesn't break it, if it's coming to hit this next resistance level, and then the moment it hits it, it will trigger. So the moment price falls to that particular place, that's you set your limit order below there, it triggers and then it goes up in your direction. But the disadvantage of this thing is that price may just hit your limit order, trigger it, and continue to fall. So it all depends on what you want to do. So for the sell limit order, like I said, the opposite is true for the sell limit order. Now price is usually below, it was going up, and for whatever reason you expect that the moment it gets to this particular point, it is going to fall. So now what it means is that I may be asleep, or I may want to go out and hang out with friends, and I don't really know when exactly this market is going to hit this place. So instead of for me to come back and say, oh shit, I knew it was going to hit this place, but I went hanging out with friends, does that necessarily mean that I should, simply because I'm trading, I shouldn't hang out with friends? No, come on. Or if I'm a long-time trader, I'm expecting something to execute in like days, I shouldn't go on vacation? No. So what it simply means is that I can say, okay, this price, I've already projected that once it gets to this place, it will trigger. It's going to fall, start falling. So I expect that if it's the moment it hits here, it hits this point, it starts to fall. Now, the disadvantage with this type of order is that sometimes price may hit your limit order, trigger a limit order, and continue going up, meaning you are in huge loss if it continues going up. So it's usually best once you set your limit order, it triggers, you set a stop loss few pips above it, depending on what you are looking at, as in your project, your risk to reward ratio, and then your trading strategy. These are all the factors you need to consider before placing your stop loss. Likewise, in the buy order, you can also do the same thing. Place your buy order, as in your stop loss, just beneath some points, actually depending on where it was, how it was, some points or some pips below the pending, that's the limit order. Now, for stop entry orders, there are different types of stop entry orders. Now, in stop entry orders, or you set these orders above the price if it's a buy order. Now, it's just the inverse, the opposite of what the limit order is. Remember that in the limit order, price we have to, if I am, let's say I want to buy in a buy limit order, it's expected that actually price was falling. You understand? So price was falling, so it means my buy limit order is usually below price. And then in sell limit order, my sell limit order is usually above price. So price have to get there to trigger the sell order. You understand? So in the stop, that's the stop entry orders now, like a buy stop. In buy stop order, what actually happens is this: price, like in a buy stop now, unlike in buy limit order, in buy stop, price is above the limit. The limit order is above price, and in the sell limit, the sell stop order, price is below the the entry order is below price, so to say. Now, look at what I'm talking about. Now, notice here in the buy limit order, price, this is the limit order, price was falling, so limit order is below price. Are you seeing it? But in the buy stop order, price, the limit order was above price. Price started its movement from here. I placed my buy limit order somewhere around here, so price got to here and triggered it and continued moving. So the disadvantage of this is that, as in, okay, I expected that, let's say the advantage is that I expected that price will continue to move in this direction, so I place an order above this candle, and then the moment it gets there, it triggers and continues moving in my direction. So, but the disadvantage here is this: price may hit this place, trigger the order, and start falling, and when it starts falling, I'm in a huge loss. So for the sell stop order, notice it's just the opposite. So when price does, you place the sell stop order below price, unlike in the buy limit order where it has to be above price. That price has to get there, hit and trigger, and then start falling, moving in the direction you anticipated. Here in the sell stop order, you are moving in the same direction. So just instead of this was price here, I can decide to, even instead of placing the sell stop order here, I can place it here. So it was coming to this place, I just place the sell stop order here, and then it continues moving and falls in my direction. So stop loss order is where you can place your stop loss, your take profit order. Just like I am already in this trade, and then I expected that this market is going to continue moving in this direction, but what if it decides to go against me? I wouldn't want to lose more than this amount, so I place a stop loss order there. Or if I'm in profit, there are times that prices may get to this particular place, and the moment it hits this point, it starts falling. So I wouldn't want a situation whereby price does losing the exact money I've already made, and even losing more than it, even into my account, my initial balance or my initial deposit. So what will happen is I will just project and say, okay, once price gets to this particular point, this profit is okay for me, I don't want more, I take it here and I'm okay. So trailing stop is the one that is usually automated. You can set it 20 pips, 25 pips in between. So what happens here is that as price keeps moving, your stop order trails with it, moves with it. 25 pips apart, it moves with it. Price was exactly here. The moment it gains 25 pips, it starts floating from there and trails with it up. If it's a stop loss order, it trails with it 25 pips until the moment it hits exactly that after the first that's hitting that 25 pips trailing stop loss and goes far beyond that, it closes itself. Now other forms of order may include one order cancels the order. Now in one order cancels the order is simply when you can set a buy stop, but it does a buy order and a stop order. So price is somewhere in the middle, and then the one order is above, the other is below. Now the moment price if any of whichever one that triggers, if it's the sell order that triggers, then the buy order will automatically be cancelled, so that it won't happen. We won't have a scenario whereby price decides to go back again and it will go and also trigger the other order, and you see we're already having two trades that are almost in losses. So good till cancelled, the order will still be very good, will be okay until you cancel the order. Good for the day. This type of order closes at the end of every day. At the end of every day, the order is expired and then there's nothing else about it. So one order triggers the order. You can set an order that, okay, it's just like a conditional order. It's also referred to as a conditional order. What it simply means is that if I place this order, once this order is being triggered, okay, the second order should be able to be triggered as well whenever prices gets there. But if this first order is not triggered, nothing is actually going to trigger the next order. So next we'll be talking about trading sessions. Now, as we all know, in the forex market, if you remember in our earlier class, I told you that in the forex market you trade 24 hours exception of weekends. Now, but simply because we trade 24 hours does not mean that all throughout the 24 hours, throughout the entire session, the market is actually at the peak of its activity. No. What happens is there are times where the market is slow, there are times where the market is so volatile and very much liquid. So now, just like in every other activities, there are some sessions usually more active than others, and then some sessions are less active than the others. So that is exactly how it is. So now there are about 4 major sessions, and these include the number one is the London session. You understand? Then the New York session, Tokyo session, and the Sydney session. Now this chart exactly will show you how it works. Now normally the London session starts from 8 o'clock GMT and runs all through to 16 o'clock GMT. Then the New York session takes off from 13 o'clock GMT and runs down till 21 o'clock GMT. Now depending on daylight saving, and then this time these trading sessions may change with an hour or thereabout. So now, but if you notice what happens, there is a time of an overlap between the London session and the New York session, and these two sessions are actually the major trading sessions. These are the sessions that, in fact, these are the most volatile sessions, that the activities in these sessions are just so much that you can actually make good money in these sessions. So now when the session becomes more volatile is when the American session, that's the New York session, now is coming into and is coming in while the London session is still running. That should be around 13 o'clock GMT. From that moment down till 16 o'clock GMT. Most times trading during those periods can be very much profitable, but now that doesn't mean that it's always like that. There are times that, in fact, the volatility in the market may turn out to be in the Tokyo session. You understand? after American session has already closed. That's even when you see the volatility in the market. So it doesn't necessarily mean that it's always like that. No, there are times these things changes depending on what is driving the market at that moment, whether it's a news event released by those in the Tokyo session or in the Sydney session. So now, like I told you, the busiest of this, or the most volatile of this session, is the overlap between the London session and the New York session. Now there is a trading strategy known as London breakout strategy. Now in other videos I'll be teaching you practically how you can trade this London session, and then using some indicators as well on your chart or any of the free charts provided by TradingView, you can trade this London breakout strategy and become very much profitable just using this London breakout strategy. So now there are common terms that are used in Forex, like we've already talked about these: the ask price, the price you are willing to buy. Then the balance is actually, when we head up to the MetaTrader 4, I will show you how this balance works. So, and then usually the value of your account, not including unrealized losses or open positions, because your exact balance is what is happening after you've closed down all trades. That's what your balance is. So the bid price is the price you're willing to sell at, or so the cost of carry quoted in terms of dollars or pips, a holding, and that's the price you pay for holding an open position to the next day. So currency futures contracts, that's future contracts traded and exchanged most typically the Chicago Mercantile Exchange CME, always quoted in terms of the currency value with respect to the US dollar. Parameters of the futures contracts and standardized by the exchange. Now drawdown. So now drawdown actually, just as it's written here already, drawdown is actually measuring that's how deep the losses you've had actually. Now imagine a situation whereby you had an initial balance of $1,000, and then that $1,000 went down to, like, let's say $500. Automatically you've had a drawdown of 50% drawdown. Now, but what if and the way drawdown is measured is not taking account of the overall, like, let's say probably the account now was $1,000, then you took it to $1,500. You get, after taking it to $1,500 and then it came down to $1,000, you'll be assuming that you'll be saying, okay, I only had in fact I had zero drawdown because you've not entered your main capital. But no, that is a 50% drawdown already. You understand? So that's a $500 drawdown that's already occurred in that account. You understand how it goes? So equity is usually your balance plus unrealized profit or open loss, as in open positions, profit and loss open positions or open positions. Now what it simply means is that if I have trades that are running, plus or minus, that's if there are about 2 to 3 trades, one is in a profit and 2 are in losses, the overall plus or minus may be minus $50. So if my account balance as at the time I entered that trade was $500, so what it will be saying, you might say, okay, you may be thinking that if I close this thing now, I'm still going to have no. What is actually happening there is that your equity is, that's the balance, your initial balance, which is $100, plus or minus. Now plus that's unrealized profit open and that's position open and close open positions that are either in losses or in profit. If you add it, like I said, remember you have 3 trades that are running. The first one is in minus let's say plus $50, and the last 2 are in minus 100 altogether. So that's plus and minus, you have $50 minus $50. So your equity now is going to be plus $450 because you open the positions on a $500 balance. So FX is usually the short term for foreign exchange, and then fundamental analysis, we'll talk about that in the next class, where I'll be teaching you the different types of analysis, both fundamental and technical analysis and sentiment analysis. So basically it's using both macro or strategic assessment of where a currency should be heading to based on how the currency is doing. You understand? Based on other economic factors in the country. So I've already taught you leverage, then limits, and then liquidity, margin. All these things I've already taught you. So just do well to check through the previous video and then see how even margin call. I taught margin call in the last video, and it's just simply a call that your broker places to you to remind you of a position you are having that is about to be liquidated, and if you don't do anything to add funds to that particular trading account, you stand a chance of losing the entire asset. Market order means to buy at market price, you know, offer, peep. I've taught all those things. Rollover just is the changing of futures when the expire of the new contract. Spot. So even technical analysis, tick, all these things I've already covered them. So this is a practical way you can place these orders. So for the buy stop order, you can simply right click on your MetaTrader 4 account. You can see buy stop. You understand? Once you hit this, did you notice? This is a buy stop order. Why? Because until this price will not be triggered, until prices gets to this particular point, then I can place my stop loss anywhere below. You understand? Now you can modify the order or delete the order. Now remember, this is just an account where I have to show you, just it's nothing here actually. And then for sell limit order, now these orders, any of these orders, there are different ways you can actually execute these orders. You can come to new order. You notice instant execution. If you hit sell or buy at instant execution, after selecting your stop loss, your take profit, the volume of trade you want to trade, is going to execute at the instant at the current market rate. So you can either, if you want to now place a pending order, which is buy or stop order or limit order, can you see there is buy limit, there is sell limit, there is buy stop, there is sell stop. So if I say sell limit order now, boom, notice what is happening. I'll have to place where exactly do I want the sell limit order. So I will say let's say 1.20380. so the moment I place it, okay, 1.20823. so let's say a pending order, sell limit 1.20980. Did you notice? So what it basically means is that if price gets to this particular point, automatically to trigger the sell order, will only be in profit if price continues to fall. But if price continues to go up, we are in a loss. Do you understand? 1.20950, 1.20950, and notice what happens. Boom, the order is being placed, and once prices gets to there, I'm expecting that this trend line should hold it and it should fall. But if it continues going up, it means that particular trade was on a loss. So that's that for the sell limit order. So but for the stops, if it's for the stops, now I can right click, trading, buy stop order. The moment price gets to here, it will place a buy order and continue moving until it gets to here, probably where I'm expecting to take my profit. I can place my take profit just above here. Well, I'm going to record a separate video where I'll be showing you practically just how to do this. Just practically, the only thing we'll be talking about will just be talking about these orders, placing them, the stops and everything. So thank you very much for staying to the very end of this video. So we will be seeing you in the next video, where I will be teaching you the different types of analysis, that's technical analysis, in-depth knowledge. Now I'll be giving you in-depth knowledge on technical analysis, fundamental, and even sentiment analysis, and how to combine the three of these types of analysis in order to have an edge over the market. Thank you very much. Don't forget, if you're getting value from this video, help us smash the like button and then share with friends who might also need this video as well. Thank you very much. God bless you.